What we have seen is during this time, the raw material prices got inflated everywhere. Crude being which everyone tries, but it is not only about crude. It is about crude, yarn, multiple chemicals, gas, and so on.
Or market caps that are cheaper or segments that are cheaper? How do you play that? And, essentially, how constructive are you on? Welcome to Moneynomics by Axis Mutual Fund. I'm Divya Menon, and with me today I have Head of Equities, Shreyas Devalkar. So, in today's episode, we will have Shreyas covering topics from how geopolitical scenario is impacting Indian markets, equity markets, what is his take on the earnings season, what are the sectors he's looking at, and some bit on the valuations as well. So, welcome Shreyas. So, like I mentioned, let's start off with the hot topic, the ongoing turmoil, geopolitical turmoil. It's escalating, de-escalating, markets are moving up, moving down. Although last April was a good month for Indian markets, but still it's not very convincing. So what's your take? How are you viewing the markets?
Sure. So, probably just continuing from our last time's discussion on, because last time the war started in February end.
Yes, it's
March,
2 months.
March entire month was the impact of the same. What we have seen is during this time, the raw material prices got inflated everywhere. Crude being which everyone tries, but it is not only about crude. It is about crude, yarn, multiple chemicals, gas, and so on. So it was partly because of supply chain disruption. I would not call it as a disruption. There is a delay or there is a price increase. So most of the companies, so far what we have seen during the result season, also the commentary has been that there is not exactly disruption, but there is a price inflation. And as of now, companies are trying to absorb it. So they are taking it as a cost challenge rather than a disruption challenge. So that with the help of their existing inventories, they have been able to manage it decently so far. The issue is about how long it continues and as always where it settles. So especially all the prices, and though everyone is talking only about crude, and there is a reason why we should track crude, but when you look at from the company's point of view, there are multiple commodities which has gone up. So where this settles would matter in a sense that it will test the ability of the company based on the demand drivers, whether they will be able to absorb or it will lead to the margin pressure. The commentary so far has been that everyone is trying to wait for one more quarter. So Q2 is the quarter where you will see the impact actually. Till now, we have not seen much impact. From the macro perspective, as always, crude creates a pressure on current account deficit. Then it has an indirect pressure on inflation. It has an impact on rates because of it, currency and BOP and so on. So this part of the macroeconomic stability, which was there for multiple years actually, with this event actually it is getting tested, so to say. So from that point of view, you will notice that is one of the key reasons why the large caps have underperformed, because as you know that the large cap companies, or larger companies, it's not about large cap, it's the larger companies of economy, are more correlated with the GDP growth and overall macroeconomic situation. So in that context, yes, there is impact on the large caps because of this situation per se. Versus, and this is one of the reason why versus other countries globally, India also has underperformed, because historically India's leverage to the crude has been much higher than some of the other emerging market companies. So to that extent, India has underperformed. If you want to talk about it from the valuation perspective, then because of these reasons, the large cap having underperformed, because of the obvious concerns in them, their valuations look reasonable. But mid and small cap are doing well. There, I would not call the valuations are reasonable, but there the growth has been better.
So, coming back to, you did mention a bit on companies getting impacted. The last earnings season, the season that is going on, the results that are coming are for the JFM, where really this geopolitical issue is not plugged in, right? So, what is the sense that you're getting from there, the commentary that you're getting from there? And, are there really any sectors or segments that are resilient in spite of this? Or, vice versa, vulnerable sectors? Which are those sectors?
So, as far as earnings season is concerned, as you are rightly highlighting, this issue happened towards the March as a month, and that's where a part impact. And in most cases, because of the inventory and etc., multiple reasons, the impact is not much, and it is not getting reflected as one would have expected. And the management commentary also, more importantly, for the April, May, June quarter is not so to say negative per se. Everyone is trying to highlight that wait and watch. We will see how these prices stabilize, and so there is no clarity as of now on that one. As far as quarter is concerned, some of the things were known, like the credit growth has been good. So from that perspective, the financial services, at least credit growth numbers, has been great. There has been mixed impact on the NIMs on the banking sector and financial services. Credit cost has been broadly stable. So that part of economy, which is large by market cap and market weight also, is resilient in that context, and especially from the credit cost point of view. If you look at other sectors in this, then in other sectors, metals, actually the commodity sector, have been showing good results, and that continued. Some of the consumer discretionary showed good result during this time, while on the other hand, IT continued to disappoint on the numbers. Obviously, there is a AI narrative as well as the numbers, but numbers sub 5% growth is not really exciting, whatever is the valuation, and that's where that sector is stuck broadly. Apart from that, what we have observed is the trends continued in this, and the trend has been that larger companies reporting slower growth, while the mid and small cap reporting better growth on a YoY basis in this quarter as well, and which is getting reflected in YTD returns or 1 year returns of large cap indices versus mid and small cap. So there is a huge gap in the returns of, and even if you'll see that after the fall in the market, the mid and small cap also bounced back very well, because again these numbers in some of these cases has been better. Broader trend which is continuing since first supply chain disruption happened because of COVID at the beginning of this decade. That trend is continuing with some additional angles to it because of geopolitics. So at that time, it was not more about geopolitics; it was only about disruption because of pandemic. While now it is with the additional angle of geopolitical issues. The trends like manufacturing, defense, energy security now, and control over the raw material or manufactured product. So these are the bigger themes which have emerged then. They are actually continuing, and this supply chain disruption led by war has further strengthened some of this theme, which may be, again, as I said, power, renewable, EVs, etc. So this pattern is getting continued in the market from the theme perspective. While from the earning perspective, as I said, yes, there has been segment like IT, even FMCG, some part of autos as well. These have shown lesser growth, while the mid cap oriented segments, especially in the auto ancillary or in case of capital goods and power sector oriented, data center oriented. So this pack is definitely doing well. Some of the structural themes like hospital, etc., on the consumption side, they continue to do well. So these are the broader trends which we are observing. The net outcome of this is as always, which has been the case for last 2-3 years. Large caps are slow growing cheaper, mid cap and small cap are fast growing expensive, and that's where our recommendation has been for the investor to be with mostly have a mix of funds. So whether you get into diversified categories or mix the large, mid, small, so that you get benefit of the both.
So, the typical questions that we get asked is in terms of valuation, what do you feel? Is markets cheap now, or are there market caps that are cheaper or segments that are cheaper? How do you play that? And, essentially, how constructive are you on equities?
As always, the cheaper segments are slow growing, and when they start growing fast, they become expensive. So the slow growing segments, compared to history, and where the derating or re-rating has not happened. The derating has happened, but re-rating has not taken place compared to pre-COVID. Most of them are in the large cap. So they are likes of private sector banks, they are likes of FMCG, IT. Actually, even auto also has not got re-rated to a large extent, because historically in last decade also auto companies have gained, some of them, this kind of multiple. So most part of large cap I would call out is that from the valuation perspective is decent and reasonable. So whenever this macroeconomic concern, as I said, that larger companies are more leveraged to the macroeconomy and the GDP growth. So once that concerns go away, there is a value out here. While in case of mid and small, there is a case because of the themes which were spoken about, and such opportunity exists there.
And from an investor perspective, what would you recommend to an investor at this point in time?
As always, that from the investor point of view, these events like war, somehow in last 4 or 5 years, multiple such events has happened. Yeah. So probably the good part is what we have observed from the investor behavior point of view, and which gets reflected in terms of DII flows. Yes, the investors has been resilient. They are aware of the long-term potential of equities, and not trying to time market is one of the learning for every one of us has been over longer period of time. So trying to be disciplined about investment is one of the important parameter here.
Thank you, Shreyas. Thank you so much for your insights. Thank you, investors, for watching this. And do remember that equity investment calls for long-term investment horizon, staying disciplined, staying invested, and treat volatility as your friends. Keep adding when the markets turn volatile. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.